We just got the reading that inflation did in fact come down. But I've got a whole bunch of charts to show you. This is going to be the 12 days of Christmas in chart format, and there's actually a lot more than 12 charts. We got to show you all sorts of stuff about consumer confidence, inflation levels, business confidence, exports by category, cryptocurrency charts. We're even going to show you a chart of Meta and how that's doing, and Amazon, show you some gap downs, whole bunch of charts that are going to blow your mind. You guys got to see this. So what is all this information telling you? It's basically giving you a story of the year that was and also what to expect going forward, what the trends are showing you. That's why we're going to get into so many charts. And what is the story that it's telling you? It's telling you that 2022 was a heavy year, it was a pivotal year, and let's all look forward to a better 2023 for many of you. This is your first time here. My name is Peter Leeds, and along with my extraordinary team, we publish one of the most popular financial newsletters of all time. Nothing in this video should be considered as personalized trading advice for you.
I think I was wrong then. There have been unanticipated and large shocks to the economy that have affected our economy badly that I at the time didn't fully understand.
Literally about 40 minutes ago, this information just came out. This is the consumer price index, which rose less than expected in November. You can see the chart of the U.S. Consumer Price Index year over year. It was up 7.1% from a year ago, but it's still declining. But if you X out food and energy, that's only 6%. So prices rose less than expected in November. Here's the one chart I always show you with a new addition now. This one here is the new addition to the chart. But you can see, this is what I always show you. 9.1, 8.5, 8.3. It just continues to decline. And what happens now, I'll give you another look ahead down the path a little bit. Once inflation starts to come down, it typically comes down pretty significantly, pretty quickly, faster than people expect. And when I say people, I'm talking about people who are trying to freak you out about inflation. And I'm talking to you about the media, and I'm talking to you about most analysts. It costs more for your family to be able to afford what they need to pay for. I get it, but there is relief now, and as I told you from ages ago, I was so far ahead of the game on this, inflation will come down, and it'll come down quicker than even now a lot of people are expecting. Here's the inflation rate month over month, and watch this. Next month, this will be a negative. Here's a chart of U.S. debt. How much debt does the government have? How much debt do we as American citizens have? And however you want to look at it, this is just ridiculous and much too high, even if interest rates never increased. But what happens when you have way too much debt and interest rates increase? The only way the U.S. government can get out of this debt bomb that they've set up is to inflate away the money, make the money basically worthless, so it makes the debt easier to pay off. Or, as I'm always telling you, they'll default on the debt. They'll have money they owe to other countries, to American citizens, that will not get paid. And the way it's going to play out is with a lot of these pension crises. You're seeing what happened in the United Kingdom. Australia's got some problems. America will be one of the next shoes to drop. There's not enough money in the pensions for what people are expecting to receive. Some estimates are putting the pensions at only 70% funded, and depending on which pension you're talking about, it can be a lot lower. A lot of these pensions are already breaking apart. And on Wednesday, the central bank's expected to announce another rate hike, probably a 0.5 percentage point. I don't know. But here's a chart of the interest rates up to this point. And as of tomorrow, you can expect that you'd add another 0.5 percentage point or so to this chart. What do I always tell you? When they raise interest rates, there's a delay, a lag, where they'll raise interest rates. The effects will not be felt in the economy until quarters later, 3 months or more. So all of these interest rate increases will have their effects down the road. The earliest ones are starting to have an effect now, but the more that they increase them to higher levels, the more time that goes by, the more strain that will be on the economy from the interest rate increases, and that's when you're going to start to see a lot of the bankruptcies and a lot of the increases in unemployment rate. Here's a chart of the trade deficit. There's a core inflation rate with food and energy. And take into account, this doesn't count energy, which has been in free fall lately. Gasoline will be less expensive. Heating oil will be less expensive. But here's a chart of the trade deficit. That's basically saying how much do we spend on products from other countries over and above what they spend on products from our country. The trade deficit is almost always significantly negative, and it's been getting bigger and bigger the more that we don't have a lot of manufacturing on our soil, and when we get a lot of work farmed out to other countries. Why do businesses do this? Isn't this a bad thing? They do it because they can sell you stuff at much lower prices. It's a much better profit margin for them. You get your car manufactured in another country where the workforce is available and less expensive, and then you can sell the car here on our shores once it's all assembled and put together for a much lower price. And the holidays wouldn't be complete without a holiday story. So picture this. You bought gifts for everybody on your list, and then you realize you forgot cousin Carl. And there's not a lot of time. You're going to see him in 2 days. What are you going to do? How are you going to get him something? Consider a digital peterleeds.com subscription. You get it instantly, and you can say, look, we just got you a subscription to one of the most popular financial newsletters of all time. Here's a chart of changes in inventories. But here's a chart of real consumer spending. People are spending a lot less right now. Not like here when they were given a bunch of money from the government. This is when everyone bought all those Peloton bikes. But you can see that this number is basically almost at the zero bound, almost flatlining at zero. And I believe that the next print, or perhaps the one after that, this will be a negative number. That will tie in with when we are in a recession. Here's one that you absolutely need to see, the business confidence. Here's business confidence. Add that with the consumer spending, and you get the feel of the direction we're going, which I've been trying to explain to you guys for a long time now. This trend will not stop today. It will not reverse today. 2023 is setting up to be a very difficult year, more difficult for people who don't prepare properly, as I'm trying to explain to you how to do. This is a chart of bankruptcies. Okay, typically you're going to have a lot more bankruptcies. Let me give you a 3-year chart here. See, 10-year chart. Typically, you've got a lot more bankruptcies than we're seeing right now. But look at this. It's been in decline up until this point. And you can see that this is the first reversal where the bankruptcies are actually increasing. And now the effects of the interest rate increases are going to put a lot of strain, especially on the zombie companies, which are all over America right now. About 300 of them are listed on the stock market, publicly traded. And there's a ton of absolute zombie companies among small business, which are not necessarily so transparent. You might not even hear about them when they come and go. They go out of business. There's a lot of defaults brewing up. There's a lot of bankruptcies. This number will increase because it's just now having the effects from the increased interest rates, which the Federal Reserve did to try and punish the economy. This is exports by category. This is all data from the year 2021, so last year. But you can see how much we export and what percentage of our exports that represents. So mostly we export mineral fuels, oils, and distillation products. A little bit of machinery, that's 12%, with reactors, boilers, electrical equipment, but 11%. And then it just goes down from there and splits apart from there. So you can see explosives and pyrotechnics, that's 1/3 of 1%, is how much of our total export picture is that sort of product. Aircraft, 5.1%. Here's the central bank balance sheet. It's coming down pretty good. That's a good thing to see. You want that to be getting lower and lower. It's funny though, because if you look at all the small businesses and even publicly traded companies, most of their balance sheets are getting deeper in debt. Those numbers are going up. But the Federal Reserve, which is causing all of this, is actually getting healthier from a fiscal perspective. Here's a chart of the interest rates. And tomorrow, those rates are expected to be increased by 0.5 percentage point. This is a problem here. where they dropped rates to near zero for so long, what that did, that distance, that duration, that entire time, it was just driving the debts of individuals, of corporations, of the government. The lower those rates were, it's not good for the banks either. It's not good for savers who want to own savings bonds because you're not getting any interest on your money. But the longer that went, it's like when I tell you a consolidation period goes, the longer it goes, the stronger the stock breaks out of that. This is the problem right here. They've put rates for too low, for too long, and that just fueled up all of this excessive exuberance, which is now coming back to haunt us. Here's a map of the worldwide interest rates. They're pretty much not healthy. You see a lot of red on this map, but what are we looking at here? Here's all the interest rates. Japan is very low, the only negative rate going right now. But America is right here. Used to be 3.25, then went 4. Now it's going to go to 4.5. Canada's up there. All these rates are pretty huge. India is going to be slowing down their economy a bit with that kind of a rate. South Africa, Russia. But look at Brazil and then look at Argentina. Basically, this rate indicates a complete collapse of an economy. And you can see a decrease in the import prices that we pay in America to get things from other countries. And you can see it is also in decline. And as this declines, that puts less inflationary pressure on products that we receive here in America. It might even be the components to build things here, but most likely it's actually a finished product. But it shows it's the 4th consecutive monthly decline. Fuel prices were down also. But here's cryptocurrencies. I wanted to show you this one. This is Bitcoin. It's up 4% today, but it's down 63% year over year. But you can see that a lot of these cryptos are down big time. Solana is down 91%. But here, if you go down to the bottom, Terra is down 100%. Get used to that if you own one of the altcoins. A lot of them have yet to go to zero, and they will. But let me tell you something, though. You'll notice that some of these cryptos went down 52%. Others went down 75%. Others went down 91%. Now, this applies to stocks especially as well. But cryptos, I imagine, also. When there's a downdraft and prices are coming down, the stocks or the cryptos which decrease less hold up better. Say, for example, the stock market comes down 40%. All stocks come down 40%. But there's a stock you like that only came down 12% or 25%, but a lot less than the actual overall decline. Those are the stocks that will come out of the downturn the strongest. They're usually demonstrating that they're a stronger investment because they're decreasing by less than the overall flow of the markets. And I just want to show you a chart of Meta. It's down significantly, and this is an example of what happens where Meta is the next big thing, and you've got a billionaire Mark Zuckerberg backing everything and changing his company name and going all in on this. And a lot of times you think that's a good thing to do. I'm going to invest in this, I'll get in early, and you think you're going to make a lot of money from it because it's the cutting edge thing. This is where a lot of well-meaning, intelligent investors wind up making a mistake. They get offside because they say, okay, I'll invest in Meta. Meta is going the wrong way. And now everything that they consider to be due diligence turns out to be a mistake. Just like when Amazon, here's a chart of Amazon. You see the gap ups and the gap downs. That shows you where there's a lot of additional strength to whatever move it's experiencing at that point. But you say, well, there's the lockdown trade and everybody is just ordering stuff from Amazon. I know I did. I increased how much stuff I bought from Amazon. Everybody did. And then they say, oh, that's a good investment then. And they invest in it, but then they have the other side of it. When you have the reopening trade, all of a sudden Amazon takes the hit because it overextended so much one way. And a lot of investors will get involved with that investment. And they're doing things right logically. But unfortunately, a lot of the best investments that you logically think are the best investments you get involved with, that takes out so many people because everyone invested in it at the same time. And everyone thinks you're so unique, but you're not. You're just part of the trend or part of the crowd that's rushing from one side of the raft to the other. So a lot of times what I'm trying to say here is that what you think is a smart way to invest, a safe way to invest, actually can backfire very significantly and very often does, especially if you're part of the crowd. And a lot of times when you're part of the crowd, you don't realize you're part of the crowd. But you are. That's why I'll get 5 or 6 emails all of a sudden at the same time over a few days just talking about the same thing. Like, what do you think about lithium? Should we get in lithium? We should buy lithium. Here's a lithium stock. What do you think? And I'm like, you guys are all part of whatever promotion you're seeing, whatever free information you're getting is going to cost you because everybody is on the side of the raft. So what is all this information showing you? I hope I'm not overwhelming you with a million charts, but I just wanted to show you a story about the year that was, and also give you my outlook about what we're looking at in 2023. There's a lot of major warning flags, and there's a lot of major opportunities here because of all the risks and all the down arrows you're seeing on the stock market. That's why you have to be active, be ready to move, and educate yourself by watching content from this channel. Put it all together, and you can see that this is not a healthy economy. It's going the wrong way. Bankruptcies are going to increase. And this is all before we see any kind of problems in the real estate market, any significant, serious, widely followed, known big problems in the real estate market. A lot of people are already underwater on their mortgages. My uncle walked away from his house in the 80s, as did a lot of people, because it cost them more to pay for the rest of their mortgage than the actual house was worth. And as always, this video is dedicated to all the people who have shown their support for this channel by becoming a member of the Peter Leeds Army. I've got a special package I'm putting together for you guys that if you're in the Army, you get it, nobody else. And that's just the first of many things I want to get out to anyone who's joined the Peter Leeds Army. We love you guys. Happy holidays. Merry Christmas. Happy Kwanzaa. Happy Hanukkah. Let's look forward together to a better year in 2023.